Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Today we're embarking on a really comprehensive exploration of the recent Q2 2025 earnings call from UnitedHealth Group. This isn't just about reviewing, dry numbers. It's a detailed look at how one of those significant players in healthcare is navigating what they describe as a truly challenging environment. We're going to unpack their revised financial outlook, the major headwinds they're addressing head-on, and their strategic reorientation across their incredibly diverse businesses, United Healthcare and Optum. Get ready for a thorough overview that really cuts through the noise and gets to the core of what's happening.
You're right. When we look at the bigger picture, this call really feels like a pivotal moment for the organization. They were signaling a very clear and I think intentional shift in their approach, moving beyond simply reporting results to acknowledging some, deep-seated issues and outlining a comprehensive multi-year plan for change. It's a pretty candid look at the complexities of the modern healthcare system, seen through the lens of a major enterprise grappling with both internal and external pressures. They're essentially hitting a kind of reset button.
Okay, so let's unpack this new tone coming from leadership because it felt, remarkably different from prior calls. They started by immediately recognizing and thanking their employees for their dedication during what they explicitly called a prolonged, challenging period. And they acknowledged a number of new leadership team members and their willingness to really reassess and re-baseline the entire business. What does this deliberate opening tell us about the internal state?
Well, I think it's crucial to understand that this isn't just, a polite opening. It telegraphs a significant shift towards internal introspection and accountability. The explicit thanks to employees for navigating a prolonged, challenging period hints at the underlying stress and difficulties the organization has faced. It acknowledges the human toll, really. And the acknowledgement of a new leadership team, along with their willingness to conduct a grounded assessment and re-baseline the outlook, that underscores a recognition that maybe past approaches or assumptions aren't sufficient anymore. This suggests, I think, a desire for fresh perspectives and a readiness to make tough, maybe even unpopular decisions.
That sounds like more than just a superficial shift then. They're emphasizing a tone of change and reform, tying it directly back to a recommitment to their core mission, to help people live healthier lives and help make the health system work better for everyone. They also highlighted the importance of fundamental values: service, responsibility, integrity, and humility. What does this mandate for change truly mean for their operations across all those different segments?
That really raises an important question about organizational identity and strategic redirection. When a company of this scale emphasizes a tone of change and reform rooted in its mission, it implies a fundamental reevaluation of how they operate. They explicitly state that some businesses require a fundamental reorientation, others need building and nurturing, and some might even require reconsideration and redirection to original purpose.
So not a one-size-fits-all approach.
Exactly. It indicates a granular, critical assessment of each segment. Furthermore, the commitment to revisiting critical processes and fundamental business practices, both internal and market-facing, suggests they're looking at everything, from how they manage patient risk to how they interact with providers and consumers. It's a clear admission, really, that aspects of their foundational operations need a serious overhaul.
And it's not just about internal processes, right? They're talking about an enormous responsibility for millions of people and the government and private programs they partner with. This comes with a promise of a real cultural shift in their relationships with regulators and external stakeholders, aiming to be proactively engaged, constructive, and responsive. How significant is this shift, and what impact could this increased transparency have?
Yeah, the emphasis on enormous responsibility highlights their deep awareness of the public trust placed in them. They're a huge player. The desire for a cultural shift with regulators and external stakeholders suggests they're moving away from potentially a reactive stance to one of proactive engagement.
Yeah.
This is critical in a highly regulated industry like healthcare, where public perception and regulatory relationships are just paramount. It signifies a recognition that simply complying with rules might not be enough. They need to actively build bridges, foster a more collaborative environment, especially given all the ongoing public scrutiny of managed care practices, coverage decisions, pricing, you name it. It's a strategic move, I think, to restore confidence.
This next point is particularly telling. They aim to reposition as a far more modern, reliable, consumer and provider-friendly enterprise. And they plan to achieve this by leveraging new technologies and approaches to fulfill their mission and ensure steady performance. What's the real ambition behind that statement, especially given the challenges they've just outlined?
Well, the acknowledgement that modernization is key to their future isn't just about fixing problems, it's about evolving the entire enterprise. The mention of leveraging new technologies suggests a significant strategic investment in areas like artificial intelligence, AI, advanced data analytics, digital tools. The goal here is clearly to streamline operations, improve the user experience for both patients and providers, and ultimately drive efficiency. This move to being consumer and provider friendly is a direct response to, let's face it, longstanding criticisms within the broader healthcare sector. And if you connect this to the bigger picture, it could really reshape how healthcare services are accessed, delivered, and perceived, moving away from a purely administrative model to one focused on user satisfaction.
Now, they're undertaking all of this in what they describe as a truly challenging environment. They specifically called out a generational pullback in Medicare funding happening from 2023 through 2026. Then there are unprecedented medical cost trends, measured not just by higher unit prices, but also by the sheer intensity of services being used and what they called more aggressive care provider coding and billing technologies. Add to that the prospects of contraction in Medicaid and individual exchange markets, the growing need to invest in new technologies, and the expectation that all healthcare entities offer a better experience. Plus, there's the continuing public controversy over long-standing practices like managed care, coverage, care management, and pricing. They even directly admitted to pricing and operational mistakes that are now getting needed attention. That's a formidable list of challenges.
It really paints a picture of a perfect storm, doesn't it? Where multiple powerful forces are converging. The generational pullback in Medicare funding is a significant external headwind directly hitting their revenue streams for several years. The unprecedented medical cost trends are a multifaceted problem. It's not just that individual services cost more, but the volume and complexity of those services are increasing. And as they noted, providers are actively using more sophisticated coding and billing practices, which can drive up costs even further. The contraction in Medicaid and exchange markets signifies reduced growth opportunities, forcing them to compete more fiercely for a potentially shrinking pool of members. And the ongoing public controversy underscores a fundamental trust deficit, perhaps, in the managed care model, with direct impacts on their reputation and regulatory landscape. Their candid admission of pricing and operational mistakes is actually a crucial step towards rebuilding that trust. It indicates that some of their challenges are indeed self-inflicted, not just external market forces.
So how are they going about restoring performance and accountability amidst all this? They're committing to engaging with purpose, transparency, and integrity. And crucially, they've brought in independent experts like Analysis Group and FTI Consulting to review critical processes, things like risk status, care management, pharmaceutical services. These reviews will happen annually with public reporting, and any variances from prescribed practice will be promptly remediated. They believe these issues are fully addressable and will help restore performance and strengthen their institutional culture. They've already made extensive management and operational changes in the past 60 days, with more to come. What does the involvement of these external experts really signify?
What stands out there is the level of external validation and oversight they're seeking. Bringing independent experts like Analysis Group and FTI Consulting adds a significant layer of credibility. Accountability, too. It goes far beyond internal audits. The commitment to annual reporting on these findings and prompt remediation signals a serious, sustained effort to address past shortcomings and to ensure that these issues are, as they put it, fully addressable. This proactive transparency is vital for rebuilding trust with regulators, providers, the public, especially after admitting to past mistakes. It also implies a deep, ongoing internal transformation, from leadership changes to operational overhauls. It indicates this is a sustained effort, not just a one-off fix.
Okay, having explored the company's broader strategic reset, let's zoom in on UnitedHealth, their core insurance business, because this is where the financial pain seems to have been most acutely felt. They're approaching this segment with greater humility, greater transparency, and a renewed determination. The primary driver of their 2025 earnings shortfall is quite stark. Their pricing assumptions were well short of actual medical costs. This has resulted in a revised outlook reflecting a massive $6.5 billion more in medical costs than initially anticipated. What does this widespread financial hit point to?
It is indeed a staggering figure. It underscores a fundamental miscalculation in their projections. The key insight here, I think, is that this isn't just an isolated issue in one segment. It's a systemic miscalculation impacting nearly every part of their insurance business.
Right.
Breaking down that $6.5 billion, a little over half, about $3.6 billion, stems from their broad-based Medicare portfolio. Then, roughly one-third, or $2.3 billion, is from their commercial business, split pretty evenly between plans offered through the Affordable Care Act, or ACA, and their employer business.
Okay.
The remaining pressure comes from Medicaid, notably due to an elevated trend in behavioral health services. And what's more, they removed about $1 billion from previously planned portfolio actions that are no longer being pursued, which further impacted the outlook. Plus another $850 million from unfavorable prior period items, primarily from 2024, and some one-time settlements. This indicates that while current trends are a major problem, there's also a necessary clearing out of past financial overhangs.
Let's zero in on Medicare then, because that's the biggest piece of this shortfall. They admit that when they prepared their 2025 Medicare Advantage offerings back in the first half of 2024, they significantly underestimated the accelerating medical trend. And they didn't modify benefits or plan offerings enough to offset these pressures. This was compounded by sector-wide plan exits by other insurers and an increased service intensity from care providers. And tell me about this. Their increasingly flexible orientation to Medicare networks and plan designs actually hindered their ability to make in-year adjustments. So flexibility became a trouble.
Yeah, the confluence of factors here is quite complex. First, underestimating medical trend is a significant misstep. It suggests a gap in their predictive analytics or maybe just market understanding at the time. The impact of sector-wide plan exits is also noteworthy. It could have pushed higher acuity, more complex patients towards their plans as other options disappeared. The phrase increased service intensity from care providers is crucial. It means that for every patient encounter, more procedures, tests, services are being bundled in, driving up the cost per visit.
Right.
And yes, their flexible network designs, while seemingly beneficial for patient access, ironically made it harder to pivot quickly and contain costs mid-year, which, raises an important question about the trade-offs between offering broad access and maintaining financial control in a rapidly changing cost environment.
So on those trends, specifically for Medicare Advantage, what's the detailed picture? What are they seeing?
Okay. For Medicare Advantage, physician and outpatient care account for about 70% of the cost pressure year to date. But inpatient utilization, meaning hospital stays, that accelerated through Q2 and is expected to become an even larger portion of the full-year pressure.
Interesting.
They're seeing utilization increases in emergency room visits and observation stays, and consistently more services being bundled per encounter, making each interaction more intense and costly. Initially, their Medicare Advantage trend assumption was just over 5%. Now they expect it to be approximately 7.5% for 2025.
Wow.
And their Medicare supplement trend is expected to be over 11% this year, compared to 8-9% in recent years. This just confirms the broad-based nature of this increased activity. The key takeaway on these trends is just a dramatic acceleration across the board, reflecting a systemic uptick in healthcare utilization and intensity.
Moving beyond Medicare, what are they seeing in their commercial and Medicaid segments? You get similar pressures.
Yeah, for commercial, they're also observing higher than expected medical cost increases, particularly in outpatient care, though inpatient trends are less affected there. Notably, orthopedic spending and pharmacy infusions are significant factors driving these costs. In their ACA business, the primary cause of underperformance is a morbidity mismatch, meaning the health status of the patients they priced for was, healthier than what they actually experienced. That led to revenue shortfalls.
Okay.
For group fully insured plans, the medical trend is approaching 11%, which is about 100 basis points higher than their initial expectations. In Medicaid, the trends are similarly elevated, with an unanticipated acceleration of cost in behavioral health running at a staggering 20% trend, plus increases in pharmacy and home health.
20% trend in behavior. Wow.
It's huge. And they anticipate this existing rate and acuity mismatch, where funding levels don't match the actual health risk of members, will extend well into 2026. This highlights the inherent difficulty in aligning reimbursement with actual population health needs in these government programs, given the lag in state rate adjustments.
So, given these immense financial pressures, what concrete actions are they actually taking right now to turn this ship around? Are we talking about reactive price adjustments, or is this a more fundamental strategic overhaul?
It's definitely a multifaceted and, I'd say, fundamental strategic overhaul. It goes beyond just responsive pricing for 2026. They're intensifying their efforts by stepping up their audit, clinical policy, and payment integrity tools. This is a direct response to that aggressive care provider coding and billing they mentioned, aiming to curb inappropriate spending and identify waste and abuse.
Right. Makes sense.
They're also strategically shifting towards narrower networks and focusing on more discipline-managed products, especially in Medicare Advantage. That signals a move away from the flexibility that hindered them, prioritizing cost control and care coordination now. And here's where it gets particularly interesting. They've scaled their artificial intelligence, or AI, efforts across health plan operations, not just to improve patient and provider service, but crucially, to drive significant cost savings through enhanced efficiencies.
Okay, AI playing a big role.
Seems so. And for Medicaid, they're actively engaging with state partners for immediate and regular rate updates to address that rate-to-acuity mismatch, recognizing the unique funding dynamics there.
Looking into 2026, their pricing strategy is intensely focused on margin recovery and returning to earnings growth targets. In Medicare, their historical operating margin target was 3.5%, but due to changes from the Inflation Reduction Act on the Part D program, which means higher revenue without directly impacting earnings, the equivalent new target range is 2.4%. They're aiming for the lower half of that 2.4% range in 2026, advancing further in 2027. Their Medicare Advantage pricing for 2026 assumes a trend approaching 10%, up from the current 7.5%, to account for acceleration, fee schedules, and provider coding. This will involve significant benefit adjustments. And it's a difficult decision, but they plan to exit plans serving over 600,000 members, primarily in less managed PPO offerings, with similar approaches for Medicare Supplement, Group MA, and standalone Part D. That's a truly significant shift, isn't it? Impacting hundreds of thousands of members.
It is. It's a clear signal of a significant strategic recalibration, prioritizing financial stability over pure membership volume in certain segments. The adjustment of Medicare operating margins from 3.5% to 2.4% due to the IRA highlights how legislative changes can mechanically alter financial metrics, even if underlying productivity remains similar. The decision to price Medicare Advantage for a nearly 10% trend in 2026, compared to the current 7.5%, shows a very conservative, forward-looking approach. They're anticipating cost acceleration, fee schedule changes, aggressive provider coding. But what's most impactful here is that difficult decision to exit plans serving over 600,000 members. This isn't just a minor adjustment, it's a significant strategic retreat from less managed PPO or preferred provider organization offerings.
The ones that give members more flexibility but are harder to control costs in.
Exactly. This pivot towards more tightly managed products where they believe they can better control costs and drive outcomes raises an important question about how these exits will impact member choice and market dynamics in those affected areas. It's a big deal.
How about their commercial and individual exchange plans for 2026? What can we expect for pricing and membership there?
Okay, for their commercial business, because renewals happen year-round, they have more dynamic pricing capabilities. They anticipate higher trend continuing into 2026 and 2027 and expect double-digit premium increases.
They'll be bitches.
Yeah. This aggressive pricing will likely lead to some membership decline and a shift into level-funded and self-funded product categories as employers try to manage higher medical costs on their own. In the individual exchange business, those ACA marketplace plans, while they're prepared to participate in most of their 30 markets, they'll approach them far more conservatively for 2026. They may even exit select markets if they can't achieve the rates needed to account for what they call higher market-wide morbidity, meaning sicker populations than anticipated. Furthermore, the projected expiration of premium subsidies across the ACA market is expected to cause a significant decline in membership nationally. And they're very mindful of adverse selection dynamics, where only the sickest people might stay enrolled if subsidies disappear as they reprice these offerings. This implies a significant tightening of their risk appetite in these markets.
In Medicaid, what's the outlook for this critical government program? Still facing those lags?
Yes. For Medicaid, they anticipate that the persistent lag between funding levels from states and the actual health risk and utilization of members will continue into 2026. This is expected to result in additional margin compression, even projecting a loss within the non-dual segment, that is, Medicaid members who are not also eligible for Medicare in 2026.
A loss in that segment.
That's what they're projecting. They also factored in membership losses from the early adoption of recent legislation, like redetermination processes. Despite these challenges, they remain committed to serving people through the Medicaid program wherever state support provides what they deem responsible funding. It underscores their mission-driven approach, but also their necessary emphasis on financial viability.
So taking all these adjustments into account, what does this mean for United Healthcare's long-term view? What's the takeaway?
Well, when we look at the bigger picture, their long-term view for United Healthcare acknowledges that the American health system's long-standing cost problem isn't just present, it's accelerating. Despite the current pressures and their necessary strategic adjustments, they are embracing their responsibility to continue driving better health outcomes while striving to keep healthcare affordable. Their operational and pricing strategies are designed to responsibly navigate these immediate financial pressures with the ultimate goal of setting a stable course for a more sustainable future. This suggests a commitment to evolving their model to address systemic cost issues, not just temporary setbacks, recognizing that the very nature of healthcare costs seems to be shifting.
Okay, having dissected the challenges facing United Healthcare's insurance arm, let's shift our focus to their other giant, Optum, their health services segment. While it's meant to be a growth engine, their overall performance has not met expectations, which they're approaching with humility and a strong commitment to improved execution. They're refocusing on performance discipline with a bias for action and transparency. They've also brought in significant new leadership. Roger Connor is CFO, Krista Nelson is COO of Optum Health, Divya Suryadevara is CEO of Optum Insight and Optum Financial, and John Mart overseeing Optum Rx. What do these widespread leadership changes at Optum signify?
The immediate and decisive leadership evolution at Optum is highly telling. Bringing in new top-tier talent for key roles like CFO, COO, and CEOs for Optum Insight and Optum Rx signals a rapid and comprehensive effort to inject fresh perspectives and, frankly, executive rigor into the segment. This bias for action and transparency from new leadership suggests a cultural shift towards more direct and aggressive problem solving. It raises an important question. What were the gaps in previous execution that necessitated such a widespread change? And how quickly can these new leaders drive the promised improvement and return Optum to its expected growth trajectory? It underscores a serious intent to not just manage, but to fundamentally transform Optum's performance.
Let's really dig into Optum Health, particularly their value-based care, or VBC, business. They maintain a core belief that VBC has the potential to transform healthcare and consistently delivers better outcomes. They even cited evidence that Medicare Advantage patients in accountable arrangements are 20% less likely to be hospitalized and have 11% fewer ER visits compared to traditional fee-for-service. Yet they admit they're struggling to align this model with new funding dynamics and are facing self-inflicted execution challenges. How big is this struggle, and what's driving it?
This is a critical point, yeah. Because value-based care is often touted as the future of healthcare, shifting from paying for volume to paying for outcomes. Optum Health serves nearly 20 million patients, with VBC accounting for about 65% of its revenues and covering 5 million patients in fully accountable arrangements. So it's huge.
Right.
The struggle is significant. Their VBC business is contributing approximately $3.6 billion to Optum Health's overall 2025 earnings shortfall. That's 55% of the total shortfall for Optum Health.
Oh, okay.
The drivers are threefold and roughly equal in weight, they said. First, the enrollment mix. They're getting more complex, dual-eligible patients, those on Medicare and Medicaid, and new to Optum patients who were previously underserved, often from other plan exits. These new patients require significant time and resources to manage, leading to negative margins initially.
Okay, that makes sense.
Second, accelerated medical trend, particularly in physician and outpatient care for Medicare and behavioral health and Medicaid, just like we saw on the insurance side. And third, they underestimated the health risk status of these new members and had suboptimal execution of the V28 risk model transition.
Ah, V28 again.
Yes, that's a new industry-wide framework for how Medicare Advantage plans are paid, designed to reflect patient health more accurately. Their missteps in adapting to this have created an $11 billion financial headwind for Optum Health over 3 years. $7 billion of that impact is realized through 2025, which is actually $2 billion to $1 billion more than they initially estimated. They also misexecuted their internal offsets to these funding cuts.
So a large part of this is that V28 risk model transition, and they're saying insufficient pricing from United Healthcare and other payer partners pulled through as insufficient capitation rates for Optum. For our listeners, can you briefly explain what capitation rates mean in this context, and what's the current financial state of their VBC business as a result?
Certainly. In value-based care, capitation rates refer to a fixed payment per patient per month that Optum receives from an insurer, whether it's UnitedHealthcare or another payer, to manage all the healthcare needs for that patient. This means Optum takes on the financial risk for that patient's care. If the capitation rate is too low relative to the patient's actual medical needs and costs, Optum loses money.
Got it.
And right now, their fully accountable VBC operating margin is only about 1% in 2025. That's a steep decline from over 3% in 2024 and nearly 5% back in 2023.
It's 1%. Ouch.
Yeah. They attribute a large part of this misexecution to a non-standardized and overly localized management approach, which they are now addressing with urgency by moving to a more concentrated regional operating model. This raises an important question. How much of the VBC promise can truly be realized if the operational foundations aren't consistently strong and standardized? They've also seen margin compression due to significant growth in new membership cohorts, with nearly 40% of their VBC patients joining since the beginning of 2024.
So newer members are dragging down the average.
Exactly. And when you look at patient cohorts, margins clearly improve with tenure. Patients they've managed since 2021 and prior are generating an estimated 8% plus margin in 2025. 2022 and 2023 cohorts are at 2% margin. But the 2024 through 2025 groups, they're actually at negative margins. So while strong physician engagement and accurate diagnosis drive improvement, the process is currently too slow and variable across practices.
Okay, given all that, what's their remediation plan for value-based care? They mentioned a 4-key element plan. What are they doing?
Right, the remediation plan is pretty comprehensive and multifaceted. First, they are focusing on improving and standardizing their clinical model, anchoring it in primary care, and supporting it with wraparound services like specialists or home care.
Okay, clinical model first.
Second, for margin recovery, they're aligning 2026 benefits and product portfolios with payer partners to address the final year of V28 headwinds. This includes ceasing arrangements for about 200,000 patients, primarily in less managed, fully accountable PPO products. That's about 40% of their current PPO patient base in VBC.
Again, pulling back from PPOs.
Yes. They expect this, combined with increasing rates for higher-risk patients, to mitigate about half of the remaining $4 billion V28 headwind in 2026. Third, they're focusing heavily on operating cost discipline. They expect to deliver almost $1 billion in cost reductions for 2026 through aggressive operational disciplines. That concentrated operating model, standardized approaches, and technology integration, leveraging AI for efficiency.
Okay, AI again for cost savings.
Seems to be a major theme. This will help them offset the remaining V28 impact. They expect VBC margins to remain consistent with that 1% margin in 2026, advancing again in 2027 and beyond. They're also optimizing their clinical practices, transitioning some to partial risk or even fee-for-service arrangements, and exiting fully accountable products in certain markets where necessary, so a lot of adjustments.
So beyond the fully accountable VBC, what about Optum Health other businesses? What else is under that umbrella?
Optum Health also includes fee-for-service care delivery, which accounts for about 15% of its revenues. This includes businesses like home care, ambulatory surgical care, and medical practices not yet fully accountable, meaning they are paid for each service provided rather than a fixed patient rate.
Right, the traditional model.
Exactly. While most of these perform well, generating low double-digit margins, their primary care and multi-specialty practices that aren't fully accountable are running at negative margins. We're talking hundreds of millions in losses this year.
Really?
Yeah, this pulls the overall fee-for-service delivery business into a mid-single-digit margin range. They are actively working to improve payment yields, how much they get paid for each service, and productivity here, targeting strong year-over-year earnings growth in 2026. The third component, services, makes up 20% of Optum Health revenues. This includes managed behavioral health and military veteran services, and these combined have almost 10% operating margins, performing relatively well.
Okay, so what's the long-term outlook for Optum Health overall, given these challenges and all these remediation efforts?
Well, they expect continued pressure for the rest of 2025, naturally, but they anticipate meaningful improvement in operations and earnings growth in 2026, though with a longer path to recovery for the value-based care business specifically. That 1% margin isn't changing overnight.
Right.
They've updated their long-term target margin objective for Optum Health to the 6% to 8% range overall, with about 5% specifically for value-based care. This updated target acknowledges that more time and investment are needed for these practices to reach their full potential and mature into profitable cohorts. Despite the misexecution being a clear setback, they believe the long-term growth potential remains intact and significant. They see substantial opportunity for the decade ahead, even if early investment losses from new cohorts temporarily impact the blended margin. They seem committed to this VBC model long-term.
Let's move to Optum Insight now. They see a great need for technology and data products to make the health system more efficient. That sounds like a huge opportunity. So what's holding them back, especially given the company's broader push towards innovation and AI?
Yeah, what stands out here is their candid assessment of underperformance. Optum Insight has not fully capitalized on this market need due to what they described as an unfocused product suite, lagging innovation, and a longer than expected impact from last year's cyber attack, referring to the Change Healthcare incident.
Ah, right, that was
It
huge.
was, and it unfortunately diverted significant resources away from business innovation and growth towards remediation and security. For 2025, their outlook is adjusted downward by $1 billion. About half of that is from a slower than expected recovery in their volume-based businesses due to the Change Healthcare cyber event and related expenses. The other half is from pausing planned portfolio actions to prioritize growth and innovation across their broader portfolio. So while the market opportunity is definitely there, internal and external factors have held them back from really seizing it fully.
But they sound optimistic about the future for Optum Insight. Despite these setbacks, what gives them that confidence? What are they pointing to?
They are indeed optimistic. They highlighted they've got a talented team in place and are actively recruiting for next-generation AI products. They see strong structural tailwinds as both payers and providers are actively seeking technology solutions to drive efficiency. That need isn't going away.
Sure.
Their deep customer relationships and domain knowledge are also key advantages. They're also strategically combining Optum Insight and Optum Financial to offer unified solutions with greater financial flexibility. Their AI-based product portfolio is starting to launch. They mentioned an AI-powered RCM solution, revenue cycle management helping providers streamline billing that's already out, and an AI-powered real-time coordination of benefits launching later in 2025. They also noted that their fintech agenda, their financial technology initiatives, has been underinvested but has a distinctive platform with significant potential for future growth. So they see a path forward.
Finally, for OptumRx, their pharmacy services business, how are they performing, especially in this dynamic environment of new drugs like GLP-1s and rising costs?
Optum Rx continues to see high and consistent client retention, which indicates strong customer satisfaction. That's a positive sign. They expect revenue growth of $18 billion, or 13%, with earnings growth just over $200 million, or nearly 4%. Now, that revenue growth is largely driven by the increasing utilization of high-cost, low-margin specialty drugs.
So revenue up, but margin pressure.
Exactly. What's crucial to understand here are the earnings constraints, which come from four main factors they laid out. First, about $150 million from the removal of previously planned portfolio actions. Second, $50 million from corrective actions and plan adjustments in a couple of ancillary businesses. Third, about $150 million is a headwind from the initial launch phase of their private label business, Nuvela, though this is expected to deliver significant affordability and strong earnings as it matures.
Okay, so a short-term hit for Nuvela.
Right, an investment phase. And fourth, GLP-1s, those drugs for diabetes and weight loss, while beneficial for appropriate patients, represent a significant headwind of about $160 million for their pharmacy services businesses due to their high cost and growing adoption.
Okay, that makes sense. Let's quickly go over their second quarter 2025 financial results then. Revenues were nearly $112 billion, a 13% increase year over year, showing growth across both UnitedHealthcare and Optum. However, adjusted earnings per share came in at $4.08, which is below the prior year, primarily due to those pricing and medical cost trend factors in UnitedHealthcare and Optum Health that we've been discussing. They also mentioned about $1.2 billion in discrete items. What were those about? Cleaning house?
Yeah, essentially. Over half of those discrete items, which is quite significant, reflect unfavorable impacts to their ACA exchange offerings. That includes accelerated second-half losses and the establishment of a premium deficiency reserve, basically setting aside money for expected future losses due to higher patient morbidity across the exchange market. The remainder came from the settlement of several outstanding items that had been in dispute or for which collection had recently become questionable, most of these stemming from prior years. This is a crucial detail because it suggests they're taking steps to clean up the balance sheet from lingering issues rather than all of it being new, current period problems. It signals a move towards greater financial transparency.
And can you give us some quick Q2 specifics for UnitedHealthcare and Optum segments, hitting the highlights, just the key takeaways?
Sure. For UnitedHealthcare, revenues grew over $12 billion to $86.1 billion, but operating earnings declined by $1.9 billion to $2.1 billion, specifically due to those medical trend factors. Their Medicare Advantage growth for the year to date was 650,000 people, including dual-eligible members. The ACA exchange business faced over $600 million in unfavorable impacts. Commercial membership growth was less than anticipated due to competitive dynamics. Medicaid continues to face pressure from the lag in state rate updates.
Okay, and Optum.
For Optum Health revenues actually declined by $1.8 billion to $25.2 billion due to contract adjustments and those Medicare funding reductions. They now expect to add 300,000 new value-based care patients this year, down significantly from initial outlook of 650,000 as they strategically focus on improving operating performance first. Their long-term target margin objective for Optum Health has been updated to 6.8%. Optum Insight saw revenues increase by $285 million to $4.8 billion, a 6% rise, but customer recovery after the cyber event is slower than expected, impacting their full-year outlook. They still have a strong contract revenue backlog of $32.1 billion, though. Optum Rx revenues grew by $6 billion, or 19%, to $38.5 billion, driven by new customer adds and specialty products, with total adjusted scripts up slightly to 414 million.
Finally, what's the revised full-year 2025 guidance summing up all these changes? What's the bottom line for the year?
Okay, the bottom line. They now project adjusted earnings per share, or EPS, of at least $16 per share. Revenues approaching $448 billion, which is still an 11% growth over 2024. Their full-year medical care ratio, or MCR, the percentage of premium spent on claims, is now expected to be 89.25% plus or minus 25 basis points. That's a huge increase from their initial 86.5% midpoint, driven by all the factors we've discussed.
Yeah, that MCR jump is significant.
It is. This means the second half MCR is expected to be just under 91.5%, with the fourth quarter being the highest. The full-year outlook also contemplates a total of $1.6 billion in potential settlement items, an incremental $1 billion over the $600 million recognized in Q2. Their estimated tax rate for the year is about 18.5%, lower due to the revised earnings outlook, but the second half rate is expected over 20%. Cash flows from operations are expected to be around $16 billion, about 1.1 times net income. They increased their dividend by 5% in June and are balancing capital use, maintaining a strong balance sheet and credit rating, and honoring long-standing commitments like the pending Amedisys transaction. Their updated share count reflects only repurchases completed earlier in the year.
So as we look to the long-term outlook, what's the leadership's overall conviction despite this challenging year and the significant financial readjustments they've had to make? What's the mood?
The leadership maintains a strong conviction. They're signaling resilience. They acknowledge this is a challenging year, absolutely, but firmly believe they can overcome these challenges as they claim they have done before. They highlight the deep commitment of their team. They're focused on regaining intensity, precision, and execution disciplines. Their overarching message seems to be that their customers and shareholders deserve it, and the health system expects them to function at their full potential. It signals a firm resolve to steer the company back to its growth trajectory and rebuild confidence.
What's the path to recovery they envision for 2026 and beyond? How do they get back on track?
They expect the extensive efforts discussed today to steadily improve performance. This path begins with, and they use this phrase, respecting pricing basics, meaning accurate, disciplined pricing, advancing their foresight acumen, their ability to predict future trends better, and implementing better, more intense, and decisive overall management.
Back to basics, essentially.
In many ways, yes, but also driving better business practices, improving the consumer and provider experience, and accelerating investments in key areas to strengthen their foundations and modernize their businesses. This modernization is anchored in practical innovations and those scaled AI applications we talked about. They are continuing to evaluate the near-term investments needed to meet their long-term growth potential, while acknowledging the challenging environment in the year ahead. So it's a strategic blend of fundamental discipline and forward-looking innovation.
And a big theme throughout this call was rebuilding trust and transparency. How are they approaching that in a concrete way? What are the actual steps?
Yeah, what stands out here is their explicit and public commitment to rebuilding trust through both cultural change and increased transparency. That was a point reiterated from their June shareholder meeting. This involves ensuring a wide range of stakeholders, from regulators to patients, have confidence in the integrity of their company and its business practices. They are moving forward with an assessment of key policies, practices, and associated processes, with findings expected by the end of Q3 and their first performance measures report due in Q4.
Okay, so public reporting is coming.
Yes. And crucially, they've retained those independent experts, Analysis Group and FTI Consulting, to oversee and assist in these reviews. The goal is to continually strengthen and advance their compliance environment. This demonstrates a serious effort to move beyond mere regulatory compliance to a robust, verifiable integrity, which is essential for a company of this scale and influence.
What about their long-term growth outlook and revised margin targets across their businesses? Where do they see things heading after this reset?
Okay, for 2026, they expect solid but moderate earnings growth, moderate being the key word there. However, they see their earnings growth outlook strengthening quickly in 2027 and pacing steadily upward over succeeding years, returning to their historical trajectory. The framework for their long-term growth outlook remains intact, they say. They expect to pace back steadily to low double-digit ranges and advance from there.
And what drives that long-term growth?
It's driven by reasonable year-over-year organic growth from well-run businesses, the compounding effect of deliberate productivity gains, doing more with less, and the compounding effect of capital applied through share buybacks and evolving their business model toward a more expansive, less fragmented, and more integrated view of healthcare markets. Regarding margin targets for UnitedHealthcare, no fundamental change to the commercial target range of 7–9%. Medicare is reframed to 2–4% due to the IRA's impact on Part D, but they expect similar underlying productivity. Optum Health's overall target is 6–8%, with value-based care specifically targeted at 5%. This target acknowledges that more time and investment are needed for those practices to reach full potential.
Right, that 5% for VBC is lower than the overall Optum Health target.
Exactly. Optum Insight is seen as having strong potential for a remarkably performing, high-margin business from technology-enabled services. They are identifying cost opportunities within the enterprise, but also focusing on areas of underinvestment, like Optum Insight, Optum Financial, and their AI agenda. They expect these investments to translate into good contributions for 2026 and accelerate significantly in 2027 and 2028.
Let's really drill down into their internal management processes and underwriting. They're talking about returning to very basic fundamental discipline and greater intensity. What does that mean in practice for such a massive organization? How do you actually do that?
Well, it sounds like a deep structural shift in how they operate at every level. They're implementing a much more intensive monthly management review of business performance. This goes beyond just financial numbers to include detailed operating metrics, external stakeholder relationships, future potential, progress on remediation efforts, the whole picture.
More comprehensive reviews then.
Much more. This involves a comprehensive business-by-business assessment of performance prospects, particularly in the near term. They're also broadening the engagement of their management team and enterprise resources to take a fresh, objective look at all businesses. This leads to a more narrow, concentrated agenda of priorities, faster decision-making, and significant personnel changes, particularly across Optum, which are already in motion. They've returned to monthly business meetings focused on 6 underlying strategic directions. They'll continue to drill down into these businesses for 2026 planning. This is a fundamental reassertion of top-down operational rigor, designed to foster discipline and accountability.
And how are they strengthening their underwriting assumptions and conservatism, especially given the significant miscalculations in the past? What's changing there?
Well, while they believe they still have strong people and processes for product filings and business analysis, a key change is becoming, as they put it, more respectful of the environment and its dynamic nature.
Okay, more respect for uncertainty.
Essentially, yes. This means deliberately contemplating that dynamic, unpredictable nature in their pricing across all businesses, including commercial and Medicare. For Medicaid, they're intensely using data and analytics to engage state partners for appropriate rates that more accurately match the new population acuity and utilization trends. They're also strengthening their forecasting process through an internal audit review of guidance and significantly boosting their actuarial resource base, the experts who assess financial risks.
More actuaries.
Seems so. This involves looking at underlying trend builds across company and membership cohorts and meticulously analyzing revenue composition, which is complex due to risk model changes like V28. They're building out and strengthening their analytics capabilities, leveraging new approaches like AI to pull in signals earlier, adapt quicker, and propagate insights rapidly across the enterprise. While they already use third-party experts in these processes, the focus now is on enhancing judgment calls made at the close of processes, especially market reads and predictions, and broadening the oversight and conservatism of these critical decisions, aiming for a more cautious and accurate approach overall.
Okay, pulling some key insights from the Q&A section of the call now. Let's talk about Optum Health and how payer pricing is expected to flow through to them in the future. Is that headwind turning into a tailwind?
That's the expectation, yes. The key insight here is the direct connection between payer adjustments and Optum's financial outlook. Payer adjustments, including those from UnitedHealthcare and other partners, are now expected to flow into Optum's capitation rates. This creates a potential tailwind for 2026, a significant contrast to the headwind experienced this year.
Okay, that's a big shift.
It is. This positive impact is combined with benefit reductions negotiated with payer partners and operating cost reductions, notably from honing their operational model with AI. Their deep engagement with patient cohorts is also improving performance over time as those cohorts mature. These combined efforts are expected to mitigate about half of the remaining $4 billion V28 headwind in 2026, setting the stage for a more stable future for Optum Health.
How about the Medicare Advantage margin progression? What's the expected trajectory for UnitedHealthcare there?
They expect their broad-based UnitedHealthcare Medicare margins to be at the low end of their new normal range, around 2% to 2.5% for 2025. However, due to the aggressive actions they're taking for 2026, including meaningful benefit cuts, planned reductions in less profitable offerings, and pricing towards that 10% medical trend, they anticipate expanding those margins to a range of 2.5% to 3% in 2026.
Okay, moving up slightly.
Right. Their stated goal is to reach the midpoint of their target range, so maybe closer to 3% by 2027. It signals a clear, deliberate path to margin recovery.
And for Optum Health value-based care margins, particularly beyond 2026, what's driving that longer-term outlook towards the 5% target?
Well, the V28 transition created that significant revenue hit, but their analysis clearly shows that performance shifts dramatically with patient tenure. Remember, their year 1-2 cohorts are still at negative margins, year 3-4 cohorts are at 2%, but critically, year 5+ cohorts are performing strongly at 8% plus land.
Right, the maturity matters.
Immensely. The focus is on strategically taking risk in markets and products where they're most confident, primarily HMOs, with employed and contracted physicians. They are being more circumspect, as they put it, about the time and investment needed for new practices and cohorts to reach full potential. Despite the initial setbacks, they see significant growth opportunity for the decade, implying continued long-term investment as new cohorts mature and eventually contribute positively to margins, lifting that average towards the 5% goal.
Delving into Medicare Advantage patient populations, retail, group, and special needs, what did they reveal about how these different segments are performing and how they're addressing them specifically?
Okay. The group business, which serves employer-sponsored MA plans, saw elevated trend pressure but is repriced annually, offering a regular opportunity for adjustment, so manageable. Retail and special needs plans, specifically DSNPs for dual eligibles and CSNPs for chronic conditions, are generally performing in line. They actually said DSNPC SMP growth is accretive to the enterprise, meaning it adds to earnings, due to strong care management tools tailored for these complex, high-needs populations. They plan to continue leaning into these areas.
So special needs plans are a bright spot.
Relatively speaking, yes. For 2026, meaningful adjustments, pricing, product design, benefit cuts, exiting those PPO plans are being made across both individual and group Medicare Advantage to drive margin progression overall.
What are their Medicaid margin targets and outlook, especially given the noted lag in state rate updates? Still looking tough there.
Yeah, it is. They expect their non-dual core Medicaid business to be at break-even for 2025, primarily due to persistently high medical trends and increased service intensity. For 2026, they anticipate negative margins, ranging from -1% to -1.7%. That's a direct consequence of the 12 to 18-month lag in the state rating cycle. The rates just don't catch up fast enough.
-1 to 1.7%. That's rough.
It is. Their targeted rated margin with states for core Medicaid is around 2%, with a blended target adjusted to 2.4%, mirroring the MA adjustments due to the IRA. This suggests a long, challenging road to profitability in some Medicaid segments.
What level of commercial premium increases should we expect for 2026, and what's the goal? You mentioned double digits earlier.
Yes, they confirmed they expect double-digit premium increases for 2026 across their commercial business. This aggressive pricing is explicitly aimed at recovering margins closer to, though perhaps slightly short of, their 7-9% target range in 2026, with full recovery anticipated in 2027. It reflects their urgent need to offset those higher-than-expected medical cost trends and get back to their desired profitability levels.
And on those Q2 discrete items, the settlements, were they primarily tied to Optum Health's value-based care issues or something else entirely? Where did that $1.2 billion actually hit?
They clarified that these settlements were not predominantly tied to Optum Health's VBC challenges. Instead, they represent a range of items across different businesses. These include questioning the collectability of company receivables from other entities, as well as resolving disputed items with customers or providers, some dating back a year or more.
So a broad cleanup.
Exactly. They provided a detailed breakdown. Approximately $850 million was within UnitedHealthcare, about $500 million in Optum Health, roughly $200 million in Optum Insight, under $100 million in Optum Rx, and around $100 million in corporate items. This indicates a broad cleanup of lingering financial disputes and questionable assets across the enterprise, signaling a move towards a more transparent and conservative financial posture.
How will Medicare margin recovery be split between improving the medical loss ratio versus operational efficiency? Where's the focus?
It seems the margin recovery in Medicare will be driven by both key levers. MLR improvement, spending less on claims as a percent of premium, will come from optimizing plan design, focusing on durable and care-managed plans, and making meaningful benefit adjustments.
Yep.
Operational cost efficiency is also a critical focus, leveraging AI for efficiency, improved forecasting, generating early insights to drive faster decisions, streamlining processes, all that contributes. Both elements are considered critical and will work in tandem, it seems, to support their margin recovery towards their long-term targets.
Finally, their commitment to care capabilities and value-based care. Any changes there, specifically with the Medicis acquisition still pending?
Their commitment to adding breadth and scale of care capabilities to support value-based care remains strong and unwavering based on their comments. They are progressing with the Medicis acquisition, emphasizing its importance as a foundational part of home-based care within their VBC model. They view it as a critical asset for delivering care where patients prefer it.
So home care is key.
Super important, they said. They underscore the need for diverse clinical assets, mental behavioral health, specialty care, ambulatory surgical centers, serious illness care, to serve diverse patient needs and achieve better health outcomes, improved experience, and ultimately lower costs. In the near term, their focus for these acquired or developed services is on driving productivity, performance, and payment yields, ensuring each capability contributes effectively to the overall VBC mission.
Well, this UnitedHealth Group Q2 2025 earnings call truly presents a picture of a major healthcare enterprise in a phase of, well, significant reorientation and reckoning. From confronting deeply underestimated medical costs and refining pricing strategies to implementing a profound cultural shift towards greater humility and transparency, their path forward involves deliberate, multifaceted changes across both their insurance and healthcare services segments. The emphasis on leveraging AI, optimizing value-based care, and a renewed focus on fundamental business disciplines highlights a clear strategic intent to restore performance and build for sustained growth, even amidst the challenging and dynamic industry landscape.
Indeed. It's a complex picture, no doubt, but also one of determined action and a visible commitment to long-term recalibration. They are acutely aware of the challenges and seem committed to a systematic overhaul. It's going to be fascinating to watch unfold.
So as you reflect on this, consider this provocative thought. Given the sheer scale of the changes UnitedHealth Group is implementing, from exiting plans for hundreds of thousands of members to adopting new internal disciplines and technologies, and the ongoing pressures on the healthcare system as a whole, how might their efforts to internalize higher medical cost trends and refine its business practices influence the broader healthcare market? Not just for other payers and providers, but for us as consumers and patients in the years to come. Will we see more managed care, fewer choices, or perhaps a more efficient technology-driven system emerges from these challenges? Something to think about. Thank you so much for tuning in to the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.